Hello, everybody, and welcome to our monthly investment discussion meeting. I think, as everybody has seen over the past, couple months this year, that markets have been on their way down as we've been entering this economic slowdown. And obviously, we all wish that everything was the other way around. But sort of going into this year, we knew it was going to be a bit of a rough year. But between what's going on with the war in Ukraine, the Federal Reserve raising interest rates, and just the higher levels of inflation, I think what's been unexpected is how fast this slowdown has really come down upon us. So things that we want to go through today are really about resetting expectations, looking at really how we got to where we are today, and what we can really look for moving forward, and what types of opportunities we still see within the markets, and to really look for silver linings, and make sure that while there is this short-term turbulence, that we do have that long-term outlook in mind for all of you as well. So, Jared, if you want to talk about the resetting expectations and really what you're seeing, how markets have sort of changed our philosophies right now.
And when you think about that, we just thought it was timely with this because resetting expectation goes in so many places throughout the economy. Because to what you said, Michael, I mean, this has been so abrupt. We expected a tougher year, but the conditions across the board have changed dramatically in the last week, the last month, and the last 3 months, really. And it's just a time to take a deep breath, whether you're running a business, looking at your portfolio, and see where we're going from here. Because with the benefit of hindsight, a part of the reason that got us here was the markets, the economy were on a sugar high from the huge stimulus and the money printing off of COVID from the Federal Reserve, keeping interest rates at zero for longer than they should have, again, with the benefit of hindsight, and the huge stimulus from the federal government. So all of those pulled a lot of growth forward that last year we all expected would continue, not at the same pace. And what's happened is that's abruptly come to a halt. And the reality has set in that all of that extra stimulus, we are now trying to get out of or past that at this point. So again, if you take a deep breath and really rewind to, let's say, the start of 2021, and really look at the expectations from there and where things are, whether it's your business, whether it's your portfolio, and then reassess conditions right now. I think you come from a different lens that if you focus solely on where was I 4 or 5 months ago to where I am today, versus the reality that, again, with the benefit of hindsight, all that stimulus went into cryptocurrency, real estate, stock prices, and now here we are, abruptly kind of coming off that sugar high at the same time. But when you go back to 2021, I think it's a different viewpoint. So now if you look at kind of conditions overall from that standpoint, David, on what's changed, like interest rates, for example, in the last few months.
Yeah, so as far as interest rates, and we've seen the overall interest rates go up, and it provides an interesting opportunity in bonds. And we'll talk a little bit more about that. But if you look at interest rates at every level, from the shortest term to the longest term, which is 30 years or so out there, those rates have really gone up. They started this year very low, and then as the Federal Reserve in their meetings have continued to raise those rates, the rates have moved higher. So for example, if you think back to the first meeting in March is when we saw an interest rate increase. We saw a 50 basis point interest rate increase in May, and a historic 75 basis interest rate increase yesterday. So the Federal Reserve continues to raise interest rates, and that's the idea, is to slow down the economy. If you make the cost of capital higher, it's going to pull some of the demand out of the economy. Now, the question that we kind of have to look at is what's the impact of that going to be on the supply side? But from a demand perspective, it's definitely tapering the demand, and that should bring inflation expectations in line in the future. It's just going to take some time.
And when you look at portfolio allocations today versus maybe the expectations going in the year, and again, reset back 18 months, the beginning of 2021, and now that interest rates are a lot higher, as we're thinking about rebalancing, even though you've seen a dramatic decline, 20+% in a lot of the stock market year to date, rewinding and resetting, it's not a bad time still to be looking at locking in higher yields or higher dividends, as you said, David, because of where things are likely ahead. I mean, the reality is it's going to take a while to get through this period of higher inflation and a tougher Fed. This is not something we're going to get out of in the next month or a few months, right? It's just going to take some time. And now with cost of capital up, that's might be a little bit challenging from an investment perspective if you're running a business, but from a lending perspective or taking advantage of higher rates, it's good to lock in those yields. So there really is a lot of opportunity to still rebalance and kind of get through things. Because when we look back to, let's say, 2008 and 9, during that period of time, it changed our business thinking from a planning standpoint in retirement, toward retirement. And again, one of the biggest things we learned is you really have a lot of cash flow coming into the portfolio. And we've been talking about this all year, where it's kind of that cash flow is king mentality. And that's what's been in favor in the market. Sure, everything is down this year, but if you have a lot of income covering what you need, it helps to buy through these turbulent times that we're in the midst of, and likely still have some ahead. And again, that's what we pivoted to in 2008 and 9. And it's just a good tool in times like this as things have changed overall. So Michael, as we're looking at, the planning side, how about housing, right? What's the impact, as you're resetting expectations with the huge increase the last few years in home prices, but now mortgage rates in the last couple of months?
Sure. So I think you're really starting to see a slowdown in housing. Jared, as you said, with the increase in prices, and now we're seeing an increase in mortgage rates. The affordability has definitely come down, and it's taking, I think, a little bit more time for home prices to adjust lower to accommodate the higher mortgage rates. And it is something that, moving forward, it is going to be harder for people to continue to afford housing. And, it is something that they might have to, again, push back, a year or two just to increase sort of the amount that they're able to save, to put away for that down payment. And where we are with inflation and sort of how much money is already really spoken for, or how much more money is spoken for, I should say, due to inflation, it really only makes that equation harder for a lot of people to achieve.
And if you look, David, you mentioned the Fed raising interest rates 75 basis points yesterday. Looking at what they said yesterday, what are some updates from the Fed, both short term and as we look to the rest of the year?
Yeah, I think there were a couple of key statements that were made yesterday that really we should be aware of and kind of stay on top of. I think one of the things that Jerome Powell had mentioned was that they're not looking to induce a recession, right? He's looking to slow down the economy. And if we come back to the example that Michael just made about housing, right? If rates are up and it slows down housing activity, there's not going to be as many trips to the retailers that sell housing goods or things to make updates, right? Or changes that you inevitably make with any house you purchase. And so that's going to take some demand out and allow the supply chain to recover. But other things that were mentioned was that essentially the Federal Reserve is really looking to balance inflation against employment. Those are their two mandates. And so right now, employment, to be clear, and we're seeing very elevated inflation. So as interest rates increase, they're going to stay on top of the employment picture and keep an eye on what's happening there. You still have a record number of jobs open, I think 2 to 1 for each job seeker, 2 jobs for 1 job seeker. So those are some of the key elements. But as we look ahead, and as the Federal Reserve is committed to raising rates, the other thing that they mention is moving more aggressively now and front loading some of those interest rate increases is going to give them flexibility later into the years. So as we head into the rest of the year, we are anticipating more interest rate increases, but if the employment picture changes, if the economic picture changes, the Federal Reserve is giving themselves the cushion to be able to slow down. And then the next question becomes, at what point is there stimulus, and at what point do rates ultimately come down if there's a slowdown in economic activity, which again makes the fixed income environment, very attractive right now.
When you look at what you said, David, bottom line, that the Fed is their sole goal at this point is to bring down inflation, right? And they've been very aggressive about that. The challenge that the Fed is facing, a lot of the inflation they cannot control, right? And it continues to be the case. We're all filling up for a lot more at the gas pump every week or every other week overall. And that's really hurt consumer sentiment and concerns about inflation ahead. So one of the challenges facing the Fed, as we've talked about the last couple of months, is likely by the time September rolls around, it's going to be much clearer of a lot of slowdown is in the data. that the stock market decline is forecasting in a lot of ways, and you have a job market slowing down or job losses occurring, will the Fed pivot, right? And that's something to watch for. Because again, our feeling when you look generally right now, as terrible as the decline has been, we would expect the stock market to close higher than where we're trading today by the end of the year. Not higher on the year, but higher than we are today, right? And it's, again, as we're looking ahead. So one of the famous graphs our founder, Gene Lerner, always liked to have, which we pulled from the vault, was this beautifully hand-drawn graph, which we'll walk through here, that I think illustrates a lot of kind of what we're going through right now. And again, it's just a very simple graph where you have the solid line is economic activity, the dotted line is the stock market or stock prices in general. And the idea behind this is there's business cycles, so there's ups and downs. Clearly it's not this smooth, but you always like to use this for illustrative purposes about stock market being the leading indicator, and always kind of taking a step back and say, where are we? Are we at point A, where the economy is still booming, stock prices are still rising, and kind of everything's moving in tandem? Are we at point B, where we're at the peak of economic activity and stock prices are falling, right? Are we at C, where we're at a decline in economic activity, but stocks begin to rise? Or are we at D, we're at the bottom of the economy and stock prices are up, right? And it was always a good discussion to have. But again, when you think about kind of where are we, it's pretty clear, I think, to most people, we're pretty close to B, right? And that's what the stock market decline is forecasting. That dotted line, the bear market we've seen in many of the indices decline, is forecasting that future slowdown, right? And when we think about that, Michael, on where is the bottom, right? Is now a time to really get aggressive to sell? How do we think about, looking ahead to, the next few months ahead?
So I think it's important not to get ahead of yourself from that standpoint, Chair, knowing that we are, S&P is already down 20%, NASDAQ's down 30% this year. That, if we're looking at this more as as a baseball game, maybe we're probably in the 7th inning of this downturn, that there's still going to be a little bit more to go, that we haven't gotten all the data, knowing that interest rates are still going to be going up, that, in all likelihood, there is going to be a bit more volatility ahead of us. And with that in mind, though, locking in some higher yields with these bonds and more dividend stocks is not a terrible way to go. Having a little extra cash is definitely okay. And from a long-term growth perspective, you don't really want to get out of your long-term growth to a serious extent, because as markets do turn around, as Gene would say, that this is there will be historic buying opportunities, but you have to have patience and you still have to be cautious in the near term. And the one thing you don't want to do is get out of all of your growth and go into income. And when markets do turn around, you don't have any assets to grow to continue to increase your eventual income base when we do get to more normalized levels of inflation. So I guess to kind of summarize that quickly, it's look to get a little bit more conservative right now, whether it's bonds or dividend stocks, increase your income, reduce some of the portfolio volatility, but don't lose sight of your long-term goals, knowing that you do want to get to a certain place in your portfolio, that you want to. The markets are always going to go up, they're always going to go down, but over historically they've tended to really go up. So from that perspective, knowing that you do have this recovery that will come at some point, you don't want to sort of handicap yourself and really get out of some of those opportunistic type names.
Let's talk about interest rates now for a second, because again, it's been one of the hot topics of the week and really of the year, as the Fed has really, as David, you said earlier, front loaded and going to continue to front load interest rate hikes to kind of try to stop the inflation or slow the inflation overall. And if you look at this graph, what we have here is the 10-year Treasury interest rate going back the last 30 years. And when you look at the gray columns, those are recessions, right? So you had one in 91, 2001, 2008 to 9, the COVID recession, and then, what's ahead. And what you'll notice during these economic cycles, again, which is why Gene always liked that where are we graph that we just went over, is they are fairly predictable. They're not fun going through in the midst of these slowdowns, but what you'll notice is in each recession, interest rates fall, right? And we don't know what's ahead from this cycle, but the reality is avoiding a recession at this point seems highly unlikely. So looking ahead to what's happened on the interest rate market, where yields are today, despite the fact they're spiking in the last week or few months under the inflation worries, looking ahead, David, on the likely recession, there's pretty good guide that the bond market is fairly attractive from an intermediate standpoint. I mean, again, you can't time it like anything else, but looking ahead, that seems to be a pretty interesting place to invest these days.
Yeah, it's been an area that we've liked since the start of the year, and as rates have been increasing, the bonds have become more and more attractive. So what we're seeing today is interest rates are higher, and that's going to create several opportunities. So, JR, if we kind of follow the logic that you just mentioned, interest rates go up, ultimately slow down the economy. You have a recession. You saw those gray bars, and then interest rates come down. So when interest rates come down, what does that do to bond prices? Typically, that means that bond prices will go up, right? So what this gives you is an opportunity to keep cash on the side. It's not as exposed to the volatility of the market. It generates the income that you need, right? And a lot of this goes back to planning and having your portfolio kind of doing what you needed to do at the right time. Like you said, now is not the time to make major shifts. But if you're looking for opportunities in areas to kind of wait out the storm, the bond market makes a lot of sense because you're in a situation where rates are high. Certainly they're going to go a little bit higher as the Fed continues to increase. But again, once you lock in those yields and you lock in those higher interest rates, as interest rates begin to decline, as the Fed provides potentially support for the economy to try to bring back employment in the future, that gives you the opportunity to take some gains on the bond portfolio and then rebalance to growth where you're expecting, better performance. Right now, there's not a lot of support from the Federal Reserve. In fact, it's the opposite, right? They're actively working to slow down the overall economy to take out the inflation. And so bonds and anything with cash flow makes a lot of sense. So I think as far as bonds go, very, very good buying opportunity and really also alleviates a lot of the risk that you might need to take. Because if you think back to earlier in the year, if bonds are yielding 2%, 3%, it really takes a lot from your portfolio to generate the income that you might need for a year. If rates are closer to 5%, 6% now, maybe even a little bit higher, right? Then all of a sudden you don't need as much value in the bond portfolio to generate the income that you need. And it also doesn't incentivize you to take risks because I think if you look back for the last couple of years, the Federal Reserve, especially with the COVID slowdown, wanted to incentivize risk, right? They wanted to incentivize investment in the economy because there was concern that things may be shut down for a long time. Now that we are essentially back and open and the economy is strong, it doesn't need that level of support, and the Federal Reserve wants to pull some of that demand out.
And when you look ahead of signals we're watching for, I mean, as we've always said over the years, the Federal Reserve is one of our biggest long-term guides as to when to be a little more optimistic or aggressive with investments and when to be more cautious. And clearly, as you said, we're in a period where the Federal Reserve is telling investors to be more cautious. We continue to believe they're pursuing a strategy that probably will slow things down quicker. And the reality is nobody's really invested in a period of time like we are right now, where we have an ongoing war. We have inflation that's the highest in 40 plus years, and you're facing an economic slowdown. And really that's the challenge facing the Federal Reserve and an investment market where we're in right now. So when you look and study what could they do, I think Gene and I used to always study different periods of time, and you have to go back to the 1800s, right? And go to a central banker out of London named Walter Bagehot is something I think could work from the Federal Reserve perspective. Nobody's talking like this yet, but in effect, his philosophy was make a lot of money available in the banking system and economy. So keep a lot of liquidity, but instead of lower interest rates, higher interest rates, so a high price of money. And when you look at where we're facing right now, that seems to be a philosophy that could work because the Fed is facing this tough scenario where they're trying to slow the inflation, but the risk is they could really cause a major recession. If you follow a policy like Walter Bagehot, maybe it's a way to accommodate, where the reality is it's hard to bring down food and energy. So if you keep money available and raise rates, you let interest rates be the buffer of risk. Because to your point, David, if you can get 5, 6, 7%, you're not going to take as much risk on the investment. You don't need to, right? And you let that be the regulator of risk, and then let the inflation pass over time as food and energy go down. Because the reality is, because of the war, supply chain, and other things, inflation is here for longer, right? But again, the Federal Reserve is going to be a continued area of focus for us, as always, to be that signal of when to change. So as we look at kind of the start to the year, I think as we're thinking about investments ahead, and again, refocusing, I think companies are going to continue to be something to watch. So this past week, FedEx, for example, when you look at companies changing, FedEx came out and raised their dividend over 50%. And the stock jumped dramatically, its highest increase in a long time with that news. I think as companies refocus and look to what the market is rewarding these days, we're going to be watching for investments or companies to pivot from that. Because the reality is, the last 10 years, the stock market was rewarding future growth. It is not rewarding future growth today. It's rewarding cash flow, value, and such. So as companies refocus, whether it's share buybacks, increasing dividends dramatically, it's going to be something to watch for ahead, because it does dovetail nicely into how to kind of stay focused and protect in times like this. So with that, we want to thank everyone for tuning in this month. And again, as we look at kind of refocusing and resetting expectations, I think if we step back and go back from a little bit longer time horizon than the last 4 or 5 months, and look at the reality that the market was probably artificially, and the economy overall, on kind of that sugar high from the Federal Reserve and stimulus overall. And we kind of go back and reset, looking ahead to where interest rates are much higher, dividend stocks in a lot of cases are much higher. I think there's good rebalance opportunity to continue to kind of navigate through this tough market. Because again, the reality is, we think still going to be some choppiness for the weeks and months ahead. So with that, I want to thank you for listening. We'll touch base next month.